Today, hitting the wall as debt spikes and Fitch asks the question. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, this year's $6.5 trillion rally in US stocks hit a wall following hot labour market data and a ramp up in Treasury issuance just a day after a US credit downgrade by Fitch Ratings. As a result, Wall Street finished lower on Wednesday, with the S&P 500 and Nasdaq Composite down for a second straight day, as investors took profits on 5 months of gains, a day after the ratings agency cut the government's credit rating. Fitch downgraded the US to AA+ from AAA late on Tuesday, citing expected fiscal deterioration over the next 3 years, as well as growing government debt. Fitch was the second major agency to cut the country's rating. Back in 2011, Standard & Poor's stripped the country of its AAA grade, pushing back hours before her department announced its ramp-up in borrowing to plug a ballooning budget deficit. Treasury Secretary Janet Yellen called the downgrade arbitrary and outdated. The economy has recently showed signs of resilience and the debt limit was ultimately lifted, she noted. The US budget deficit surged to record levels, actually, when the government spent heavily to support households and businesses as COVID shut down the economy. It shrank last year, but now it's widening again. The federal deficit hit $1.4 trillion for the first 9 months of the current fiscal year, almost triple the year earlier figure. The US Treasury this year boosted its borrowing forecast for the current quarter to $1 trillion. That was well above the $733 billion it had predicted just back in May. The daily Treasury data through the month of July shows a pretty weak pattern for receipts, said Michael England, chief economist at Action Economics. Fitch's downgrade is a signal that the US needs to get its budgetary processes in order ahead of what looks like another political fight in the autumn, and possibly another government slowdown, said Mike Scordalis, head of US economics for Truist Financial Corp. Lawmakers in June struggled to agree on lifting the government's debt ceiling, though of course they eventually did. The US deficit has been growing for years, with little progress over multiple presidential administrations, and Fitch is saying to politicians of both parties that neither one of you has the political will to do it, Scordaly has said. The decision by Fitch to lower the US sovereign credit grade one level from AAA to AA+ highlights the debt pile that the US has built up in recent years, largely due to pandemic stimulus as well as tax cuts. More recently, the government also launched investment programs for infrastructure, technology and clean energy, and meanwhile the cost of borrowing has soared as the Fed pushed interest rates to a 22-year high. Fitch said the one-step downgrade to a rating of AA reflects an erosion of governance that has manifested in repeated debt limit standoffs and last-minute resolutions. That's because every few years, through a policy of its own making, the US faces the prospect of a debt default. A law dating to 1917 led to a fixed aggregate dollar limit on borrowing, the debt ceiling, which could be raised only by agreement of Congress and the President. That spectre hung over the US for the first half of 2023 as the US grew perilously close to a debt limit of nearly $31.4 trillion, and politicians ran down the clock. The standoff was resolved in late May, but it did fuel uncertainty again about the commitment of US political leaders to put risky rhetoric aside and meet bond repayments on a mounting debt burden. The AA+ rating is one level below AAA, and that means the US no longer has what Fitch defines as the highest credit quality. And while Fitch says that AA rating denotes expectations of very low default risk, That's a step down from the lowest expectation of default risk for AAA borrowers. And similarly, the top rating is assigned only in cases of exceptionally strong capacity to meet financial commitments, while AA tier credit scores indicate a very strong capacity, according to Fitch. Globally, Fitch is considered the smallest of the big three rating firms, which includes Moody's, Investors Service, and S&P. Rating companies assess the financial strength of issuers, including governments, and give them credit scores ranking their ability to meet debt repayments. Investors often rely on credit ratings when purchasing bonds, and their assessment can play a key role in determining how much interest a borrower pays to raise funds in capital markets. Still, US interest rates are held down by demand for the US dollar, the world's reserve currency, at least for now, and for US Treasuries, which are considered the world's benchmark risk-free asset. Treasury Secretary Janet Yellen said in a statement after the rating cut that the move was arbitrary and based on outdated data and wouldn't change investors' views on US government debt. But the yield on 30-year bonds climbed to the highest in almost 9 months before the rating was cut, as the US prepared to ramp up sales to fund a widening budget deficit. When S&P cut the US government credit rating back in 2011, it fed into concerns about the US economy at a time when Europe was in the midst of a sovereign debt crisis. Even so, the move had little long-term impact. Investors poured into US assets and government debt yields declined by year-end. Part of that was because the US economy was showing strength, while at the same time the European Union was struggling to safeguard its currency union. But this time around, financial markets are also concerned about the US economy, but the focus is on the Federal Reserve's most aggressive cycle of interest rate hikes in decades to quell inflation. In that sense, what the Fed does is likely to have a far greater bearing on US interest rates than the Fitch rating cut. Moody's still assigns the US its top rating, which has become all the more important now after the Fitch downgrade. It's also worth noting that the group of countries that still get top marks on their credit worthiness is a declining bunch. Australia, Germany, Singapore and Switzerland still have the top ratings from all three firms. Fitch also rates Canada at AA+. China, the world's second biggest economy after the US, has an A+ score from the firm. That's 3 notches lower. And the sovereign's rating can act as a ceiling on how high a company in that country is assessed, but not in all cases. The number of companies with a AAA level rating from any of the big three assessors is also a dwindling cohort, but it does include household names such as Microsoft and Johnson & Johnson. Reaction to the news pushed major indices lower, with the S&P 500 recording its biggest daily percentage drop since April 25th. It was also the first session since May the 23rd in which the benchmark declined by more than 1%. Still, several major brokerages said the downgrade was unlikely to result in a sustained drag on US financial markets, noting the economy was now stronger than it was when S&P cut its rating in 2011. July was the 5th straight month of gains for the S&P 500 and the tech-heavy Nasdaq Composite, driven by better-than-expected earnings and hopes of a soft landing for the US economy. But with markets entering a seasonally slow August, the Fitch downgrade offered an opportunity for investors to take a breather. Sometimes it's healthier to have this digestion in the market, as it brings down valuations a bit and allows for dip buying, said Quincy Crosby, Chief Global Strategist for LPL Financial. Rate-sensitive mega-cap stocks, including Tesla, Nvidia, Meta Platforms and Apple, all tumbled as the yield on the US 10-year Treasury note rose to its highest in nearly 9 months. Tech stocks get premium valuations because investors expect profit growth, and many fear high interest rates would slow the economy and dent that growth. Higher rates can make interest-bearing bonds an attractive alternative to stocks for some risk-averse investors, and projected company cash flows are worth less in current dollars when interest rates rise. The technology index dropped 2.6%, and that was also the worst performer in the 11 major S&P sectors, with 9 in total ending the day lower. Bond investors are pushing US Treasury yields to fresh 2023 highs, spooked by plans for a flood of government debt issuance and signs of the labour market's enduring strength. Treasuries fell across maturities on Wednesday, lifting the 10-year yield as much as 10 basis points to 4.12%, the highest since November 2022, and the yield on the 30-year bond reached 4.2%. That's the highest in nearly 9 months. Treasury Department on Wednesday said it plans to boost sales of longer-term debt to $103 billion next week from $96 billion previously. The total was slightly more than most dealers expected, testing demand amid a surge in budget deficits. So pronounced it helped spur the Fitch Ratings downgrade. Yields being above 4% is not what the market wants to see, according to LPL's Crosby, who also predicted investors will soon look beyond Fitch's downgrade and turn their focus to big tech company earnings due after the close on Thursday. The market is going to focus now on Amazon and Apple tomorrow afternoon, and then on the payroll report on Friday, and we'll say goodbye to Fitch, Crosby said. So the Dow Jones Industrial Average fell 0.98% to 35,282. The S&P 500 lost 1.38% to 4,513. And the Nasdaq dropped 2.17% to 13,973. And meanwhile, the relatively unimportant but important ADP National Employment Report showed private payrolls increased more than expected in July, pointing to continued labour market resilience that could shield the economy from a recession. Despite lingering fears of a recession, corporate America has continued to perform well, with around 2/3 of the S&P 500 having already reported, 79.9% posted earnings above analyst expectations. And that puts the quarter on track for the highest earnings beat rate since the third quarter of 2021. And on the earnings front, CVS Health Corp gained 3.3% after beating Wall Street estimates for quarterly profits, and Emerson climbed 3.8% after the industrial software firm raised its annual profit outlook. And meanwhile, Advanced Micro Devices slipped 7% over concerns its targets for an artificial intelligence ramp-up may be too ambitious. The worries overshadowed the chip designer forecasting an upbeat finish to the year. So if you stand back and think about it, 2 questions. Is the US debt burden getting too big? As interest rates are rising, of course, the cost of debt goes up, and that means that more of the budget has to be put against those bond repayments. And the second question, and this is the big one, is have the markets been reading things right, or are they over-egging the current situation? Because, of course, the expectation must still be that the markets are overvalued and may come back and are going to be very volatile on any adverse news. So the idea that we are going to be drifting to a soft landing with markets ever higher and earnings ever higher seem to me to be questioned by the facts. And the Fitch rating downgrade is probably more significant than the markets are currently thinking it is. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.